Okay, so you want to learn how to trade options and you want to do it without losing a shit ton of your hard-earned money. Well, the first thing to do would be to utilize the paper trading option at your disposal. If you've never traded options before and you're starting with long calls and long puts, yes, puts are long, they are not short. If you buy a put expecting the price to go down, you are long on puts. So let's get that out of the way first and foremost. Now, if you're intending on playing options, long options, calls and puts, which is what the most people do, then you're going to have to realize that you're starting at level 2 options. Now, does that mean that you have to have knowledge of level 1 to be successful at level 2? I mean, I don't want to say yes, because I've witnessed people that do not have experience with level 1 options do good in level 2, but it's far and few between. Obviously, to have a better understanding of options as a whole, you would want to start with level 1 and learn about buying the underlying, which is the shares, and then using those shares as a form of passive income to generate revenue as time goes along. Because when you start incorporating level 2 options, that's the first instance in options trading when time becomes your enemy. Theta, also known as the time factor in options, is your time decay, or it's basically the value that's always going to be being eaten away from your contracts at any given time if the market's open and time is moving on the clock. Now, that being said, that's only the case if the price isn't going in the direction of your derivative. So if you have a put option and the price is going anything but down, you will be losing money even if it's just sitting flat, because again, theta will eat the value of that contract by design. It's just how options work. It's not anything against you. It's just how options work. Time is a factor, and it's a big one, because if you're on the premium side of the market, there's two sides. You have premium and you have risk. Level 2 is all risk. Level 1, premium. You sell or write contracts to others, quote unquote, which really is the OCC. You're not really trading against anyone. You're technically trading against yourself. So when you sell a contract, and I want to get this straight for the entire group, when we say the word sell in Discord, we do not mean closing positions. When we close positions, we say buy to close, sell to open. This is the industry term. That way no one gets confused. Everyone's on the same page. Because if one person thinks sell means sell your shares into the market, and the other person thinks sell means write a covered call, like the industry standard is, then you have two conflicting viewpoints of the same word. We need to get it straight. If you are selling anything in options, you are selling the rights of contracts that come from the shares that you've already bought. Now, what do I mean by that? If you take your shares that you buy, 100 AMC shares, you now have the right to be able to create a contract or write a contract or sell a contract per 100 shares. You have 100 shares, that gives you the ability to write one contract. Now, when you write the contract, you get to pick the strike, the expiration, everything just like you were doing a long call. So I want to walk you through this because it's really very, very simple psychology that a lot of people can't grasp, and I get why, but the light will click, I swear, if you just try and simplify it in your mind. So when you're buying calls, or on the call side, you want the price to go up. You want basically the price to move down this options chain as we see the pricing getting higher as we move down. So as the price moves up or down the chain, you will make money on calls if and only if there's enough time left on the clock, and it all depends on where your strike price is. If you buy out of the money, which is not shaded in blue, you have two sections. You have one area that's blue here. That's your in the money calls. This is your unshaded area, which is your out of the money calls. There is a big, big difference in the money and out of the money, being intrinsic value. Now you can kind of see it in the percentage returns here from this options chain for AMC. You can tell that the deeper you are in the money, the less affected your contracts are by a negative move, because you have intrinsic value built in, more so on a 6.5 strike price than you would on a 8.5 strike price, because the price is currently sitting at 8.58. So whenever you're buying shares, you don't have to worry about time, because if you buy shares at $3, and the strike doesn't go anywhere for 2 months, you still are basically sitting on the same amount of value that you started with. However, if you were to buy 15 $15 strikes for AMC expiring tomorrow, they would lose. Well, let's do a better example. Let's do one that's out in October of this year, 21st. Let's say you think AMC is going to hit $20 by October 21st. So you go ahead and tomorrow you buy a bunch of $20 calls for, let's just say, 35 cents a piece, which is $35 per contract. So let's open our calculator real quick. So let's say you buy, let's go with, let's just do 10 contracts at $20 for the 21st of October for this year. So 10 times 35, your total cost, 10 times 35, your total cost is $350. I probably should have just done that in my head, but you know, I'm retarded. So anyways, $350 is your total cost. So there's two ways you could have done this. You could have bought it all at once. You could have paid for the 10 up front, got in one shot. You know the market's going to go up, and that's that. Or you could have done this. You could have bought one tomorrow. You could have bought one 2 days from now or next Monday. You could buy one a month from now. And guess what? You still have time on the clock. That is a crucial difference from if you were to sit here and buy it, let's say, on the 9th of September for, then it doesn't even go up to $20. Let's say 19. You know, look at the price difference. You're talking, you just paid 35 for October, which isn't that much further for the same strike or one above. And this one's sitting here at 4 cents at the mid price, which would be $4 per contract. So the difference between 35, what you paid for the further out options for October, big difference for the same strike, because you are paying here on the October strike for extrinsic value, which is time value. So the closer you are to expiry, you want to be more in the money. The further out away you are from expiry, the more so you can be out of the money without feeling any effects from theta, really, because as you can tell here, the theta, the negative theta here, it's lower as you get further out of the money. Now, unlike some people believe, that does not make it your friend. It's still your enemy, just at a much slower rate, because again, expiration's much further out. So when you think of options and you think of all this confusing or seemingly confusing shit that you're looking at, and you think of buying and selling, shorting and buying and selling puts and going calls, don't just let all that shit go. There's only two fucking things that you need to worry about, and that's, is the market going up or is the market going down? Because guess what? If it's going either way, you have the ability to use options to capture that profit. These options are your net. The charts are the fish. Catch the fish at the right time. Whenever you see a downtrend, you can play that and make money very, very quickly with options if you understand how they operate. So the closer you are to expiration, you do not want to go out of the money. Unless you are pretty goddamn sure it's going to run and run quickly, I would not recommend it, because 9 times out of 10, you're likely going to have them expire worthless, because options is not a price target game, it's a momentum game, and this is critical. I always see price targets thrown around for options. Don't play price targets. Play profit. Play risk management. For example, we're going to get into the core logic here in a second, but whenever you play options, you have to have a risk parameter set up. And if that risk parameter is broken, you need to exit your position, because again, you set it up for that reason. So let's say you're holding a contract at 8.5. You bought it 10 minutes ago. The price goes down to $8. That is an exit signal, because every second that you are taken out from the money, your contracts are going to depreciate at an increasingly rapid rate due to the fact that you do no longer have that intrinsic value. And since they're pushed to the other side of the board, being the out of the money strike, there's not much extrinsic value either, because the strike is so close to expiring. That is why you see price differencing between current week and this week here. The difference in the price between this $20 strike for December sitting at $78, and the strike sitting at October sitting at the $35. For a 2 month span, we're talking, what is it, 35 to 78, so double, a little bit over double. So it's all about time versus momentum. If you can get the momentum right, if you can buy that option, zero DTE, if you see it and you want to make the maximum amount of profit possible, then you play the zero DTE if you're sure of the run, because that's where the most value is going to come from if you're playing close to the money. Now, the further out you are from expiry, the further out of the money you can go, and you have more time for not only the price to get there, and you'll gain a little bit of intrinsic value on top of the extrinsic value you already have, but you could be sitting in a nice profit area, really, over time, because not only can you play those longer dated calls, you can protect them with shorter dated puts. So what do I mean by that? So if, let's pretend for a moment that you're trading right here and you have no idea what the hell is going to happen. All this chart here for AMC didn't happen. Let's start in January. Let's start right here. Let's say you bought AMC here, not knowing what was going to come. Now, obviously, if you would have held in this situation, you would have made bank if you would have held from here to here, but a lot of people didn't. A lot of people held through the dip and then have still not sold. It is what it is. But what could you have done in a normal situation to protect yourself if you didn't want to sell? Well, first of all, you probably bought a shit ton of shares because, again, they were cheap. Everyone was on the AMC train. Lots and lots of shares were being bought. But the problem was no one was utilizing level 1 options to generate income from those shares. They went up and they just held. They just held the liquidity and held the liquidity and held the liquidity, and then it ran again. And then the same thing happened. But instead of holding, there's options you can use at your disposal. Now, again, you don't have to trade options. Some people just like to invest. That's fine. This is for those who want to learn options. But it's not as complicated as it seems. It's 3 potential directions: sideways, up, or down. You're only going to be making money if you're playing level 2 if the direction's going the same way as your position. So the only way you're going to make money with calls and not lose money with calls, despite what the price is doing, is if it's going up. Because if the price is going down, your calls aren't making money, especially if they're close to expiration, because not only are they going down in value on top of theta eating away at them, it's like a stacked effect at that point, which is really, the whole deal is theta, it stacks, like, right? If the price dips on you, you get hit not only with the price difference, but the theta stacks with that. So it's more, I'm sure you've seen it, you can lose money very quickly in options, and that's part of the reason why. It's amplified. Amplified losses and amplified gains. So anyways, that's the spiel about just options in general. That was kind of just a tangent before we even get into the core logic. But first of all, there's a lot of tools you can use, right? We have, how many different indicators exist? A fuck ton, right? Shit tons of indicators. Lots of custom made ones, a lot of scripts, a lot of bots, a lot of AI, a lot of algo trading. But what really matters is what works for you. And what works for you is what you see. And what you see is what you look at. And what you look at is determined by you. So if you're looking at other people's shit all the time, you're not going to see anything worthwhile because you haven't really spent time looking at the market, like one-on-one, you and the market. So that being said, I want you to just follow along. I'm going to walk you through the exact thing I do when I go look for a core play to play with. Right now I'm holding SPY calls for January. Obviously, they took a hit this week. I'm totally okay with that. About 35%. I'm fine with it. I'm still planning on averaging into this position, but I don't want to use my cash position to do so. I would like to make revenue by playing protective puts against my SPY long calls. And obviously, this is something I would have done in the last downtrend for the last few days, obviously. But I was an idiot in playing the short settlement cycle, which did work out because I hedged with Dollar Tree. Thank God. And that's the situation I'm going to walk you through. So I played the short settlement with SPY. I had the 420 calls. I bought them on Monday. I averaged down a little bit today. Actually, I doubled down today. and I thought we were going to get a little bit more momentum than we did get, and I noticed about noon that it wasn't going to happen, so I had to start thinking options. Okay, well, obviously I'm about to lose this money because, number one, they're worthless already. It's not even expiration. Expiration's tomorrow, but I'm 99% sure they're going to expire worthless. Now, maybe there's a miracle, maybe they don't. Again, you never know. But you have to act accordingly, judging the risk that's ahead of you. So knowing full well that it's likely going to end in expiration being worthless, I had to prepare. So what did I do? I went to the charts, or actually, I went to the Discord, and this is what you do. Let's say you need a play. All you do, come to Discord, /FUD stop. When you type /FUD stop, you're going to see a commands menu pop up. You should only see one command if you didn't misspell anything. Now, if you just put /, then the list of our bots show up from the Discord. We have 3 main ones you can use for commands: options fam, Quant Data bot, and our own personal bot that we have from FUDStop in the Discord that I've programmed. Those are the 3 main ones that you want to use. Everything's moved to /. There's no more exclamation commands. This is Discord wide. This is not me doing this. This is Discord doing this. So that being said, this is your little control panel. This is your / menu. You have all sorts of helpful commands in here, multiple ones, not just from the bot I coded, but several other premium bots that we have from, again, Options Fam and Quant Data. So if you type /, you have things like navigate. If you wanted to navigate around the Discord, you can literally start typing channels and they will populate. And the way I've set it up is we have all the channels organized by industry and sector. So if you want to find ETF industries, ETF, and then look, ETFs pop up. If you want to do basic materials, BM, basic materials, consumer defensive, CD, energy, EN, financial services, FS. It's very intuitive, and that's the whole point of this. It's supposed to be very intuitive. So when we want to find a core play, what do we do and what do we look for? Well, the first thing we do is we type /FUDStop and we run the command to get the credentials here. And I'm going to have to edit this part out because I just doxed the information to the group. So anyways, first things first, call screener. If you want to learn shit, you can. If you want to get trading metrics, you can. But we're here to find core plays. So we're going to go ahead and look for a call screener. Now how this works is when you click on this, it takes you to Alphaquery. You're going to want to log in. And when you log in to Alphaquery, then you want to come back to the Discord and click that link again, and it will take you here to the screener results. Now what the screener is, this is tickers, obviously, the name of the ticker. We have what sector they're in. We have what the RSI is, and we have how many days it's been since the last earnings report. Now, the reasoning why these metrics specifically are the only ones being used is because this is what's been working for a long time, almost a year now. And what you're looking for is 3 prime criterion. Now, they're not all required, but the 2 that are, I would say, required would be you need to have just come off of earnings. You need to have an RSI that is oversold or overbought, meaning below 30 or over 70, which is exactly how these are set up here. And you want to look at a MACD for a flattening banana type shape that you can use as a entry signal on the 3-minute specific time frame. You look for these initial indicators for core on the daily. But since the screener is here, we don't have to even look at the daily anymore because this finds them for us. So you just need to go and make sure that you verify these results. Because again, this is a place to come and learn, not to be fed shit. Life's easier, but you still need to make sure that these check out. Because I don't go through and check all of these. The ones I'm playing, I will. So let's just look at a couple of these real quick for the call side. And let me show you the put side too, just so you can see it. If I were to click put screener here, then boom, it takes me to the opposite end. And as you can see, only 2 options here. PDD was a great one today. Maybe wise to hold off on this and see if we get any new results tomorrow, because tomorrow is Friday anyway. So let's look at the call side screener again, and we just verify with the charts. So let's just plug in, let's do Vive. So, right off the bat, what do you see? You see a nice daily gap because they just had earnings. We know that gaps occur on earnings. You see the RSI is oversold from the gap on earnings. It is day one after earnings, or the gap down, and you have a MACD banana somewhat starting to form. A little bit early on this one, I think. I would maybe wait a day or two on this one, maybe Monday, or maybe late end of day tomorrow, because you want to wait for this MACD to start flattening, which is when you would want to scale your entry. And with the core, this is literally all you need to look at right here. This picture here, if you see these three things in a line, this gap, or really four things, this gap, an E for earnings, a broken RSI or below 30 or above 70 in other cases, and then the MACD banana. This is literally it. This is all that there is to it. Now, the next step after this, verifying that these four things are here: gap, earnings, RSI is broken, and MACD. And really, I mean, you're verifying what the screener found. Just, it's always good to double check. It's all there. What's the next thing? Just click over to your options chain. If you need to know how to customize this, there's all kinds of help videos in Discord that you can use to do this. Again, /FUD for the shortcut version of the FUD stop command. And then you can just go to Discord help, like Discord tutorials right here. And then you have setting notifications, /commands, Discord tutorials. There's a lot of stuff to choose from in there. So I recommend going through that if you need help with some Discord stuff. But anyways, I mean, how easy is that? We have Vive, we have the options chain now that we're going to be analyzing for a couple of things, and then that's it. Now, again, smiles are great, but we're not going to chase them all year long expecting ridiculous gains. Yishay, if you're watching this, I love you, Dad. Anyways, there is a slight call smile here, but that doesn't mean we're going to buy out of the money here. The safest way, oh my god, this is down 14% today, perfect. I mean, look at that has so much value. It's easy play. Easy play. They don't expire until quad witching, which is the 16th. You don't have a weekly situation. If you buy this now, you got 15 days on the clock. So you definitely want to go in the money. So the best thing to do here would be to buy in the money, and if it goes below 170, get the fuck out and try a different one, because again, these are daily opportunities that come in every single day, update automatically around 7 p.m. Central. So when they come in, just check them out. I mean, this is a good one. IV's decent, 41, 44. Charts there. It's the setup, perfect setup. Coming off of the recent downtrend to a gap down, it's likely going to want to test that gap resistance, and then guess what? We're going to play puts again on it because it's going to go back down. So you just got to try it, and if you can always try this with paper trading. You can be like, all right, I'm going to go paper trade tomorrow. I'm going to buy it right off the open and see how that trade ended up at the end of the day. Note down what happened. Then you just learn something. You know now not to do that if it didn't work, or do it if it did work. Because we want to find out what works and then do it consistently. We can try what works for free with paper trading, and then we can repeat the results for profit. That is incredible technological change that I don't think the industry even realizes exists yet, because you can literally trade realistically with these very realistic option simulation programs that we have, and they do the same thing in the industry. You can sit here and literally trade situations and garnish experience without even paying for it. When in 5 years ago, you couldn't do this, not even close. And if you even tried, you'd lose a fuck ton of money to even try it. So, very, very incredible opportunity for individuals here to really seize their own path here. You just got to get past the bullshit. And if the colors bother you, change them, turn them to white. I don't mind turning them off, but yeah, I mean, this is it. We just found a play. There's nothing else to it. That's it. Nothing else. RSI is oversold. MACD's curling. We have a gap down fresh on the daily. It's down 14% with SSR regulations show. Set up on it. All you got to do is go in the money. And if it doesn't work out and it goes out of the money, it doesn't go out. At least you had an exit strategy and you weren't holding till expiration hopelessly while theta eats your asshole for dinner. So again, you just got to be patient and observe what is occurring as time progresses when your positions are alive, because you will learn so much just by observing in and of themselves the contracts more than anything. So Well, I guess let's go Brandon. Yeah, just stay in the money. When the market's trending upwards and we have smiles like way the fuck out here, let's chase those mofos, but not all the time. Not all the time. We got to be smart about it. You got to play both sides. You don't have to play all three. You can ignore the level 3 option, complicated strategies with IV crush strategies and things like that. That's for later on. For right now, if you want to play only the long game and only go bull or only go bear, one or the other, most people seem to affiliate with one or the other at one single time, then you got to be patient. Because if you just go full on bear tard or bull tard the full way, you're fucked. Guaranteed. You have to be either a hybrid mix or patient. The only way you can be, impatient and somewhat successful is if you're just an autistic hybrid bull bear. Like, you really got it. You got both directions down. You got to learn how to swim both ways in this water that we're in. But just keep trying, and you have unlimited amount of attempts with paper trading. And if you set your ports not at $1 million, everyone's like buying like 50,000 Tesla contracts. Like, look, Dad, I'm doing it. That's not real. You've got to set it up in a realistic simulation. I'm like, it's cool that like you made 5 million today, bro, but like set it to like $1,000 and see how you do tomorrow, because it's a lot different when you don't have $500 million to spend. It's all about risk management. So that's where I would start to anyone new is practice finding these daily plays that come in and just run paper trading on them and just watch that if you just buy one a day, buy in the money, and your exit strategy is if it goes out of the money, that's my cue, that's my sign to get out. You'll escape with minimal loss, you'll have learned something, and you have another shot at it the next day because your port didn't just bleed out. So that's my best, as far as starting, that's my recommendation. But we'll get more into it. But as far as the core, that's literally it without overcomplicating anything. That's all it is. It's those 3 things. If those 3 things align, you can exploit the RSI in and of itself, because the RSI does not like to be oversold or overbought. You can go look at any chart on any ticker, any time frame, and when the RSI is oversold, it recovers every effing time. And if you want to find consistency at the market, you want to stick to something like this that you can use as a centerpiece for consistency, and that would be the RSI, the best indicator I think that exists, other than, of course, our gaps, because there is a little trick to the RSI that we'll get into later on. But for right now, for core's sake, very, very, very simple logic.